We helped a CPA firm catch over $8 million of accounting errors that had been building for years. Here is exactly how we did it. Let us look at one of the issues we found in a client's book, a single ledger account but doing the job of 5. And by the time anybody had a closer look at it, it had buried the business with over $8 million of negative equity, which actually did not exist. Now, let me show you exactly what we found. Because if your firm has a client where the owner draws money in and out of the business personally, then there is a real chance same issue might be sitting in their books right now. Before we take on any client engagement, we run an audit, go through their current books of accounts, and prepare a full list of everything that needs fixing. For this client, I was reviewing the equity section of the balance sheet and one number completely stopped me. Now, let me share you the screen and show you exactly what we found. Sitting inside equity was a single ledger account with a balance of negative $8,680,000. Negative equity of that size for a business of this size is the kind of number that makes you stop and ask what is actually going on before you accept it as a face value. So I started tracing what was actually inside that one account, and what I found was that it had never been just one thing. For years, this account had been used to record every kind of transaction between the owner and the businesses, all mixed together in one place. Money the owner personally borrowed from the business, money the owner personally lent back to the company, personal expenses paid through the businesses, repayment of those expenses, capital contributions, distributions, all of it going through one single account for years, and that is equity. Let me tell you exactly why one single account cannot do this job. Here is the problem with that, and it is worth sitting with for a moment. A single ledger account can only tell one story. It has one running balance, and that balance either goes up or down. But what this business actually needed to track was 5 completely different stories happening at the time. Was this account tracking money the owner owed the company? Was it tracking money the company owed the owner? Was it tracking capital the owner put in? Was it tracking capital the owner took out? Was it tracking personal expenses that had nothing to do with the business? The answer is, it was tracking all of those 5 in the same place, which means functionally it was tracking none of them properly. Every time a new transaction hit that account, it just added or subtracted from one number with no way to look back and separate what had actually happened. That is how you end up at negative $8.68 million, not because the business lost that much amount of money, but because 5 different things had been added together for years without ever being told apart. So what actually the negative equity actually signals? Under normal circumstances, negative equity means something specific. It means a company's liabilities exceeds its assets. On paper, the business owes more than it owns. That is a real signal, and it is one that lenders, investors, and auditors always take it seriously. But that was not the real story here. The real story was that personal transactions had been recorded as equity movements for years, never separated, never reconciled, never classified according to what they actually were. The balance sheet was reporting what it looked like solvency crisis, and it was not one. It was a fighting problem dressed up as a financial one. Here is what made this more than just a cosmetic issue. Money moving from a company to its owner is not automatically a distribution. Depending on the facts of each transaction, it can be one of the several very different things, each with its own accounting and tax treatment. It can be a loan, which requires a note, an interest rate, and defined repayment terms. It can be a genuine distribution, which requires the company to have adequate basis to support it, along with proper documentation of when and why it happened. Or if neither of those things is true, it can be treated as a constructive dividend, which is taxable to the owner personally and is exactly the kind of characterization the IRS looks for it when related party transactions have not been properly documented. When everything gets lumped into one equity account, that classification never happens. Nobody can look at the account and say with confidence which of these 3 things any individual transaction actually was. And that is precisely the kind of ambiguity that turns into a real problem the moment anyone outside the business, an auditor or lender or the IRS starts asking questions. So here is exactly how we corrected it. Step 1. We pulled every single transaction out of that one ledger account and traced each one back to its source. Bank statements, invoices, wire transfers, anything that could tell us what a specific entry actually was, rather than relying on how it had been coded. Second step, we classified every transaction into one of the four categories. Was this money the owner owed the company? Was it the money the company owed the owner? Was it a genuine capital contribution, or was it a genuine distribution? In the third step, we built three separate ledgers to replace the single account that had been doing all the work. A due from shareholder account to capture any amounts owed by the owner to the company, a due to shareholder account to capture any amounts owed by the company to the owner, and a properly maintained equity account containing only genuine contributions and distributions, each one dated and labeled correctly. And in the last step, we reissued a corrected balance sheet, real equity restated to reflect what had actually happened, a real receivable balance where money was genuinely owed by the owner, a documented shareholder loan position where money was genuinely owed to the owner. Three accounts, three meanings, instead of one account trying to be all three at once. Once the reclassifications were completed, the negative $8.68 million equity balance was gone, not because we manufactured a better number, but because it had never reflected reality in the first place. The real picture underneath it was a business with a legitimate shareholder loan position and legitimate equity, properly separated for the first time. This is what happens when personal and business money move through the same place. Now here is the thing I want you to sit with. This was one issue in one review. We flagged more than one issue while reviewing the books of accounts of this client. This just carried the largest dollar figure because it was allowed to operate for years. If your firm has any client that personally borrows money from the business or lends it to the business even occasionally, and you cannot confidently say that those transactions are accounted in separate ledger accounts, then there is a real chance the same issue might be sitting in their books of accounts right now. I am Bidus, founder of Team of Accountants, and we are an offshore delivery team for CPA firms handling bookkeeping, technical accounting review, and cleanup for the clients they serve. If this video made you want to double check how personal and business transactions are being recorded in the client's book, then audit is the cheapest insurance you will get. It costs nothing and you will know exactly where things stand. If you got value out of this video, do subscribe. We will keep breaking down real clients issue we find in the real clients book and what they actually cost.